A standard day trading floor is defined by flashing screens and intense pressure. But a single green sprout pushing through dark soil represents a much quieter, more effective method of growth. In most professions, moving faster and working harder yields better results. Applying that same hyperactive energy to the stock market usually destroys wealth. We often treat investing like a casino floor. We buy and sell rapidly to feel productive, confusing motion with actual progress. Market investment follows a systematic process of cultivation, requiring a different temperament than a chaotic trade. To survive the market, you have to override the human urge to constantly tinker with your money. The first obstacle appears at the starting line. A baseline capital investment of 5,000 or 10,000 rupees mathematically feels small. Novice investors often expect their first deposits to generate immediate, life-changing returns. When the account doesn't double in a few weeks, they assume the system is broken. Instead of expecting instant fruit, treat that raw capital as a dormant seed placed in the earth. Long before any growth becomes visible above ground, roots are stretching out and anchoring downward in the dark. Your initial capital deposits aren't meant to buy luxuries today. Their purpose is to establish a durable anchor in the market. Once that anchor is set, a second psychological trap opens up, the internal pressure that builds when an investment moves sideways. Many investors watch a solid index fund trade flat for a few months, then liquidate the position to chase a speculative penny stock. This impatience stems from a lack of understanding of the engine driving true wealth, the compounded annual growth rate, or CAGR. This chart tracks a compounded investment over 15 years. In the flat segment labeled years 1 through 3, early earnings loop back, adding mass to the baseline. By year 5, accumulation reaches critical mass, bending into a steep exponential ascent. At this point, the original capital is no longer doing the heavy lifting. The earnings are generating their own earnings. That sideways movement provides a required incubation period. Digging up your seeds because they haven't sprouted overnight guarantees financial stagnation. Even patient investors can succumb to a third trap, the sunk cost fallacy. We see this when investors lock in small gains by selling winners too early, while holding on to negative return losers in the hope they will eventually break even. In gardening, a withered branch actively steals nutrients from healthy parts of the plant. Removing that branch cleans the ecosystem so the rest can survive. In agriculture, the 3-season rule suggests that if a plant fails to produce after 3 years of care, it is a drain on the soil. Market cycles follow a similar logic. 3 years is generally enough time for a company to prove its business strategy. If growth remains negative after that window, the asset is likely a permanent weight on your portfolio. The capital freed from those underperforming assets can then flow into high-growth market leaders to fuel their compounding engines. Portfolio management requires the analytical ruthlessness to strip away emotional attachments to underperforming capital, so the broader system has the resources it needs to thrive. Planting seeds, holding through the flatline, and pruning the dead weight combine into a single behavioral framework. This discipline replaces the anxious tinkerings of a gambler with the methodical clarity of a portfolio architect. The goal of this long-term strategy is a closed-loop, self-sustaining financial ecosystem. Overriding human impatience builds numerical wealth and yields the quiet certainty that your capital is working for you while you sleep.